prepare for what's coming. And there are a lot of these institutions, a lot of these hedge funds that are on the wrong side of the trade and maybe are doing whatever they can to get out of it and to reposition. So I wouldn't pay any attention to this volatility. Take a step back, look at the big picture. And I don't mean to and see silver no longer being suppressed by the Western paper game, because there's just not enough physical to back these contracts. And then the physical market takes over on a real price setting mechanism, which I think will ultimately migrate eastward to Dubai or Shanghai or to the BRICS exchange, which they are building right now. Everyone's looking elsewhere now, eating dinner and not paying attention. Your people are, and I am, and you are, but
in today's news recap, gold rebounds from two-week low, U.S. jobs data in focus. Gold gained on Friday as investors rushed to buy the metal a day after its prices hit a two-week low amid receding trade tensions, while the market's focus shifted to the U.S. non-farm payrolls report due later in the day. Gold hit its lowest level since mid-April in the previous session and has lost nearly 2% so far this week, the steepest weekly fall since late February. U.S. gold futures rose 1.3% to $3,263. There have been softening stance on tariffs, and situation has improved a bit, but still there are a lot of uncertainties, so gold will still be preferred by investors, said ANZ commodity strategist Soni Kumari, adding that every price correction in gold is seen as a buying opportunity. If prices continue to decline and approach the $3,000 level, it could attract a lot of investment demand. Beijing is evaluating an offer from Washington to hold talks over U.S. President Donald Trump's 145% tariffs. China's Commerce Ministry said, although it warned U.S. not to engage in extortion and coercion. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Down to like 29 or whatever it was, and shot right back up and came down, shot right back up. And yeah, we did see pretty dang close to a 200. I mean, it touched it in the middle of the night, 3,500. We're at, like 33, 30 plus right now, up over $40. And that volatility is there for a reason. Volatility keeps people sitting on their hands, not making the decisions. This is a game that is being played at the highest levels of the LBMA and COMEX. This is a game that is being played with sovereign nations and central banks and commercial banks that are trying to, I think, prepare for what's coming. And there are a lot of these institutions, a lot of these hedge funds that are on the wrong side of the trade and maybe are doing whatever they can to get out of it and to reposition. So I wouldn't pay any attention to this volatility. Take a step back, look at the big picture. And I don't mean to underestimate it. A $200 drop is a lot, but $40 move up today is just over 1%. A $100 drop yesterday is 3%. Is that really that big? No, it's not. It's 3%. Yeah, you don't want to see that day in and day out, but it seems like we're going 2 steps forward, 1 to 1.5 steps back, and it keeps going higher, base building. And that volatility, the only time people who choose to look at gold a certain way, the only time they notice it is, oh yeah, it fell by $200. But it's psychological as far as I'm concerned, and it keeps John Q. Public from crossing the Rubicon from traditional assets into things like gold and silver. And I think the people that are controlling the price and ultimately controlling the destiny of where this goes understands that. They want to reposition. But the futures market allows them to paint a narrative that keeps most people, misdirected into other asset classes, and that plays right into the hands of the big money that is quietly repositioning. As I truly do believe we are seeing a reintegration into the monetary system. I truly believe that. It won't be easy, but it will outperform everyone's expectations. When you see it fall like that, don't lose sleep. You'll see it come right back. I would venture to say, who knows what it opens up at tomorrow, but up 41 bucks after falling nearly 100 today or 80 today. So it fell by 80, it's up 40. So half of the fall today has already been has come back in the aftermarket. No one's paying attention. Everyone's looking elsewhere now, eating dinner and not paying attention. Your people are, and I am, and you are, but don't let it get you down. This is something you have to understand as someone who sees the bigger picture. Don't let the bull throw you. That's what they're trying to do. The bull wants to take as few people along for the ride as possible. Doesn't bother me at all. It's annoying, but it shouldn't bother you. It's just part of the game.
In today's news recap, Chinese investors slash gold futures positions by 1 million ounces. Key trading insights as gold prices surpass $3,500. According to the KOBEC letter, Chinese investors reduced gold futures positions by approximately 1 million ounces on Wednesday night, marking the third largest reduction on record. This follows a significant buildup of 1.2 million ounces on April 22nd, highlighting sharp shifts in trading sentiment. The adjustment coincided with gold prices briefly exceeding $3,500 for the first time, suggesting a potential profit-taking phase or risk management strategy among large-scale traders. Such large moves in gold derivatives may lead to increased market volatility and influence short-term price trends. Traders should closely monitor open interest and volume changes for potential breakout or retracement signals. The cryptocurrency market has been buzzing with indirect implications following a significant move by Chinese investors in the gold futures market. On Wednesday night, May 1st, 2025, Chinese investors reduced their gold futures positions by nearly 1 million ounces, marking the third highest reduction on record. This dramatic unwind comes just weeks after these investors added a record 1.2 million ounces to their positions on April 22nd, pushing gold prices to briefly surpass the $3,500 mark for the first time in history. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering US coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
7 to 1 or so in 2011. Ironically, I was fortunate enough to tell people to sell their gold to me and buy silver in 2010. The first podcast I did, YouTube with Big Swear, and it was 85 to 1. The second or third time in human history had been that high. And 7 months later, it was 37 to 1, just below its 200-year average. It's been stuck up in this higher range for the last several years, but for hundreds of years, it was 16 to 1, thousands of years. And then, for the majority of the last 150 years, it's averaged closer to 42 to 45 to 1 than it has up in the 70s and 80s. And seeing it at this level right now, this is rarefied air. Typically, anytime it gets near here, it slingshots down. So yes, I do. When it's coming out of the ground, it's 7 to 1. That has to tell you that at some point these numbers are just flat out uneconomical. It's mathematics. It doesn't work. So yes, I do. But, the old adage, the market can be and stay irrational longer than you can stay solvent, has been prevalent for a while. One of these days we'll wake up and see silver no longer being suppressed by the Western paper game because there's just not enough physical to back these contracts. And then the physical market takes over on a real price setting mechanism, which I think will ultimately migrate eastward to Dubai or Shanghai or to the BRICS exchange, which they are building right now. You will see price setting at a whole different level by the countries who have spent years playing the long game and accumulating, who understand commodities and things like precious metals, and will then you'll see price really reflective of that. And I think the world is tired of the charade that the West has allowed to happen with with asset prices because it's controlled where they can make oil negative $40 a barrel. Really? How the heck does that happen? Well, that's because it's controlled by the futures price. It's the tail wagging the dog, and the futures price has turned into a anyways, it's turned into a speculative arena rather than one where it's about hedging risk and exposure to those who hold the real commodities. So it'll change. And yes, I do think it will, and probably lower than that. If you said it was single digit, it wouldn't surprise me. Ultimately, it wouldn't. It's coming out of the ground at 7-1. Put the ratio at 9 or 10-1, and that's logic. And ultimately, maybe lower. So yes, I do.
What do you think of Schectman's take? Do you agree with his view on gold? Are you buying this in the stock market? Are you afraid of high volatility? Post in the comments section down below your honest opinion and share with the stackers if you're buying more, selling, or getting active in the numismatics world. Let us know. We really want to know. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.